Hello, everyone, and welcome to Pod TV's number one financially watched TV show in the world with Peter Bennett. You are now watching Wall Street Hackers. Peter received his Bachelor's of Economics at UCLA, his law degree at Miami, and an MBA in finance from New York University, where he spent the next 17 years working in Wall Street. And he's bringing to us some of his expertise, his great talent in trading, and some great tips so that we can learn how to stay above water in this economic storm. As we all know, it's been pretty challenging. So I hope everyone is doing well. And we look forward to hearing some of Peter's great tips. Welcome, Peter.
Hi, Kim. Hi, audience. So you can catch Wall Street Hackers most weeks during the year. We're going to take a brief hiatus for the summer. We'll have a show next week, and then we'll resume September 7th. So you can see it on most distribution channels on a new episode on Thursdays or some on Saturdays, depending on where you're watching. So the markets, we always cover that first. First thing we do is our favorite chart, if we can pull that up. So this is one of the themes of our show. There are several themes, actually. One is that there's probably going to be massive energy shortages, and I don't see how we can avoid it. But another one is that dividend stocks and dividend growers and payers are definitely the place to be. So this is a chart for 50 years of history to 2022, and it shows if you put in $100, you received a very nice return. If you put it in the S&P 500, of course, during that time, the Fed was lowering rates a lot. So that sort of stimulated the whole market. But the point is, comparing to dividend payers, you receive just about exactly twice the return over 50 years. And it would be worth $8,000, where dividend growers and initiators were $13,000. So where do you want to put your stock allocation? Is pretty clear. I know where I want to put mine. If something doesn't pay a dividend, I might own it. I owned tech for a while, but I like dividend payers. I'll take that bet. And I like the cash flow. So we can drop the chart. Thanks, Kim. In main news, everybody who follows the markets knows the Fed raised a quarter point. The issue is the market, as I always call it, delusional, says we're, quote, one and done. So the market is forecasting not only that the Fed is finished, but also that the Fed's going to drop rates. The only problem with this is, one, the Fed doesn't necessarily agree at all. So the Fed itself is projecting one more rate increase. And in terms of dropping, Chairman Powell just said, I think it was yesterday, somewhere in there, that he wouldn't be surprised if there's no rate drops at least till 2025. And here's the thing, forget about what the Fed thinks, nobody really knows. That's the point, because nobody knows how long it's going to take to fight inflation and what rate will really achieve it. A lot of people say it needs to go higher, or considerably higher. I just read an article yesterday, I think it was about that they think it needs to go over 6%. Larry Summers, who was the Treasury Secretary under President Obama and who is now the president of Harvard, and he was very good at predicting the rates, and that the Fed was behind, said that he thinks it has to go 0 to 2% higher than inflation. And I think inflation is going to kick up again. So Wall Street Hackers see very little progress on actual inflation and where it's going. One, unemployment at 3.6%, a 50-year low. No progress, basically, if anything, is going against the Fed. Two, energy prices, as we've been saying, likely going higher. I've said this summer I wouldn't be surprised if it goes higher in this fall. Goldman Sachs said it's possible it'll go to 100, which would be a shock to the market, because if energy, which went down 16% year over year as of last month, stops going down and starts going up, it's going to stimulate the rest of those numbers. So cause and effect. And the third thing is the government keeps spending money. I mean, there's huge stimulus mark out there. And, so nobody really knows again. And anybody who says we know isn't sure. But the market is, everything's fine. We're finished. It's all, hunky-dory, whatever. So the Fed has been behind the curve. We'll see what it takes, but this is very uncertain, and that means a lot of risk because the market is priced for this kind of perfection. Getting to technology, as we've been saying, that's been driving the market, particularly only 7 AI-oriented stocks. I'm including Tesla as AI-oriented because they have a lot of AI, but 7 stocks driving the market. But the question is it a chicken or egg kind of thing? So beta means, for those who don't know, the correlation of the stock market to a stock. So it's a very useful tool because some stocks correlate very highly or move quicker than the market and react, and others don't move that much relative to the market. So let's look at some of these 7 companies. NVIDIA's beta, its correlation with the market is 1.8. So again, an example. So if the market goes up $1, or a percent, I should say, NVIDIA go up 1.8%. Tesla, 2.1 beta. Apple, 1.3. Amazon, 1.3. Alphabet 1.1. Only Microsoft out of those 7 is at 0.9, so it basically moves with the market. But that's great, except for the market went up and tech drove it. But now what happens if the market goes down? Tech will go down a lot faster. So, I'm never against tech. I was in tech for a while and I enjoyed it. I did well with it. And so, but right now at these inflated prices, it's hard to say. And I'd rather personally be in energy where I feel more confident, or dividend payers where I feel more confident. Tech may be great. I'm not saying no, these are great companies, but there's a lot of arguments against it too. The efficient market theory, which is a big theory in MBA school, and although most financial people would know exactly what it means, it says that all information is priced into the market. So if all information is priced into the market, the future growth of tech is priced into the market. Now, there's 2 points about that. Number one, the pricing they do is based on interest rates. So if interest rates go higher, tech will be very sensitive to that because they're looking at future growth against the interest rate factor. So that alone is dangerous. But here's a quote of the week, and this really tells me about at least the dangers of tech. Again, I'm saying don't blame me if you aren't in tech because I said so, or if you are in tech and it goes down. I have no idea. Nobody is 100%, or else you just buy options and you'd be a billionaire yesterday. So here's the comments, though, from an investment manager named Louis Vincent Gave, G-A-V-E, Gav, in Sunday's Barron's. And I think this really points out potential danger. He said, AI is going to upend a lot of business models. We know that's true. It's going to be tremendously productively enhancing, but does that justify paying 38 times sales for NVIDIA? That's where I balk. If you think of the next 5 years, because if you're buying anything at 38 times sales, you'd better think of that time horizon, if not longer. Will NVIDIA still be the go-to AI play? Probably not. He says probably not. I have no idea. But either some other hardware provider will come along or there will be a better pure plays. The internet, and this is a very good point, the internet blew past everybody's expectations. But if you bought the top 10 tech stocks in 2000, you made money in Microsoft, but lost money on all the others, including Nortel, Lucent, and Sun Microsystems. Have you even heard of these companies? Nortel, Lucent, and Sun Microsystems? And they were the hot stocks in 2000, the big tech move. So again, I don't know about tech. I just want to point out the risk. And at this point, I'm waiting because I think there's a lot of downside, but maybe it'll keep climbing the wall of worry. But the bottom line is if the Fed, because now we're hitting the kind of window where reality is going to appear. So if the Fed raises a couple more times and inflation isn't under control, the market's going to figure that out in the next few months. And these are going to be very volatile months. So we'll see. But I'm cautious on tech. 5 most interesting stories of the week. I think they're really interesting, but they're always interesting. So number 1, there's a new cryptocurrency token that's making its debut, and it requires customers to scan their retina using a device called an orb. It's a biometric verification device. It's WorldCoin is not available in the U.S. at launch due to regulatory concerns. By the way, as a footnote, I've said all along, Bitcoin go to $1 million or zero, but I don't think Bitcoin and crypto have a good future, probably because more and more countries are developing or offering digital currencies that do the exact same thing. There's no secrecy, there's no more tax evasion, so I don't see a lot of advantage for crypto. Anyway, I thought it was interesting, though, that you can use your eyes to verify. And that'll probably be in a lot of other technologies soon. Number two, we try to stay away from politics. I don't want to offend anybody, and I have really mixed views anyway. But these stories I can't resist because they're so interesting and major. So, first of all, a majority of Americans believe neither President Biden nor former President Donald Trump is, quote, fit to serve another term in the Oval Office. About half say they will back another party's candidate if the two are the party's nominee. So 55% said Biden is unfit, 53% say that Trump is unfit, and 47% say a third party candidate it would be considered in 2024 in terms of their votes. So the No Labels Party is set up so they could launch a bid. And anything can happen here because it looks like Trump is probably going to be the Republican nominee. Biden's in the lead, but he definitely has issues for sure. And I'll mention that briefly. Again, I don't want to be too political for those who are offended, but, it's reality. But it could be a very interesting year. But if No Labels launches, who knows what's going to happen? It could help Trump a bit. Some people think, other people say it won't, or they could win. Third interesting story of the week. It's unbelievable what's going on with Biden. I mean, off the cuff, I watched some of the hearings of the IRS auditors who were saying how the whole investigation was a sham. They were told they couldn't look at things, they couldn't go places, they couldn't do their jobs. Then there were charges that were dropped, and now everybody probably heard about the plea deal in Delaware. This is not going away, the story. But here's part of it that I thought was very interesting. So an explosive FBI file was unveiled yesterday, revealing conversations between a trusted informant and the head of the Ukrainian gas company Burisma. His name is we'll call him Mr. Z. It's Zlochevsky, Zlochevsky. Mr. Z claimed Hunter Biden was an idiot but paid him $5 million to protect us through his dad from all kinds of problems. That's a quote. He claims he has 17 recordings, including 2 of Joe Biden, who, by the way, said he has no idea of any of his son's business dealings, but he says he has a recording of it, discussing the quid pro bribery arrangement. Now, what we know for a fact, because this was all over the press, was Joe Biden went after the prosecutor in Ukraine who was prosecuting Burisma, and he bragged about it. He said, he told Ukraine, you're not going to get $1 billion in aid unless you fire this prosecutor. And also, he bragged about it. He said, we were successful, and he was really happy about it on national TV. So we know he fired the prosecutor in Ukraine. What is the vice president of the United States doing involved with the prosecutor in Ukraine to begin with, number one? Number two, Burisma is saying they gave Joe Biden $10 million, $5 million for Hunter and $5 million for Joe. And we also know that Hunter was paid $1 million a year with no experience at all to be on the board of Burisma. This thing is just beginning to blow up. Now, my point is, number one, if you're a Democrat, you're not being helped by the press by covering this up. And if you don't believe it, if you only watch MSNBC, which says all Joe Biden did is love his son. That was a quote yesterday. How misleading. But so if you don't believe it, just watch 5 minutes of Fox Business or anything and watch the actual people coming forward. More and more people, it's blowing up. But if you're a Democrat, you have to be concerned because they're trying to cover it up. And that means more likely Biden will be the nominee. If you're a Republican, what you want to do is slow walk this. And it looks like they're slow walking it because you don't want somebody else to appear. So we'll see what the strategy is ending. But it's going to be an interesting election with the third party potentially and a lot of chaos. Another interesting story. A new $2 billion theme park and resort is being planned for Northeast Oklahoma that will be the size of Walt Disney's Magic Kingdom theme park. It's dubbed the American Heartland Theme Park and Resort. It's a 1,000-acre development on Route 66, and it will supposedly have a unique experience that rivals world top resort destinations. I believe it's supposed to be completed by 2026. It includes 6 American lands that provide guests with a walk through history. One point here is Disney's really pushed a lot of their clients, and it probably offended especially a lot of people in the mid-America who may turn around, and they had a monopoly, but all of a sudden, maybe a lot of those people will go to this park instead. So maybe their monopoly is ending. It'll be interesting. Finally, in the health area, I thought another amazing story. So intermittent fasting, the trendy dieting technique favored by many celebrities, including Kourtney Kardashian and Gwyneth Paltrow, may actually be unhealthy. Research published in the International Journal of Epidemiology, sorry for that, tracked the eating habits of 10,000 adults, and those who used intermittent fasting had a 59% higher rate of type 2 diabetes than those who ate breakfast before 8 a.m. They said the highest risk, by the way, if you're doing it, is for people who eat after 8 a.m. or diabetes. If you ate a late dinner, after 10 p.m. So these irregular diet habits may be very unhealthy. And the study showed basically that snacking was very healthy in terms of diabetes, snacking more than 5 times a day, and also that basically calorie counting was equally as effective in the end for the 10,000 adults. So much for intermittent fasting. I tried it once. It worked to a point, but I'm back to calorie counting now especially. So we'll take a quick break, and we'll be back with the pick of the week and the discussion of the week. See you soon after the ad.
Oh, beautiful for spacious skies, for amber waves of grain, for purple mountain majesty above the fruited plain.
And I guess we had a little technical problem, ran an extra ad or two, but we're back. So what to do, as always, whatever stocks you own should be dividend stocks stock oriented or all dividend stocks. And that's where I am right now. Own energy, and we'll discuss that some more, but I'm always talking about energy and the potential energy shortages coming, and be defensive, at least at this time especially. So the dividend stock of the week is actually an MLP. I've mentioned it several times. Recently I mentioned it, but I just increased the allocation again, and it's worth mentioning. So Energy Transfer, it's ET. It's an MLP, and it's a pipeline, and that's my favorite sector by far. I view them pipelines as safe and high yield, and investors often say, I'm a value investor, I'm a growth investor, I'm an income investor. But I say, if you can have all three, go for it. And that's the only place I personally, or almost the only place I see that kind of opportunity. So I love AET. It does, of course, have tax implications, but most of them are favorable. In the United States, you might get a lot of return without any taxation for a long time. You can look it up. If you own too much in an IRA, you have to be careful. What do I love about ET? A 9.3% dividend. By the way, ET and EPD, about 5% allocations each, just raised their rate, dividends, EPD by 2% and ET this week by 0.8%. Again, growth in income from a 9.3% dividend. The price to cash flow is 4.3. So that's 23% cash flow yield. That's a ton of money to reinvest, to pay the dividends. Their 5-year annualized growth is 17% according to TD Ameritrade. So why only 5%? Well, its numbers are better than my favorite MPLX. But the only thing that I'm a little cautious about is the chairman and major stockholder, Kelsey Warren, has in the past made a lot of acquisitions. And some of them have been very favorable, and some of them have been questionable. So they weren't terrible, but they were questionable. So it makes me a little cautious. So I raised it to 5%. And also I'm restricted because I'm about 28%, 29% energy. I can't be more than that. If any, that's very aggressive in the energy sector. But I like it a lot, and so I'll go with ET as the pick of the week. And the last thing I'll mention is I had a consumer staple, so I'll mention that next week because I can't only do energy, and we often go off of energy focus. And so next week I have an interesting fund, which I rarely use, but it's an interesting type fund ETF that I like as consumer staples. So panel discussion of the week. Question is, should investors who are planning for the future be more afraid of inflation, stagflation, or deflation? Quick background. There's a lot of factors, by the way, that can argue for any of the above or all of the above. It can't be all of the above. Number one, the Fed has been fighting the battle against inflation for a year and a half, as we know, and Wall Street's hackers sees little progress, as I just discussed, with unemployment low. Oil prices have been, number two factor, oil prices have begun to rise this summer. That's both inflationary and deflationary way, but initially it's very inflationary. That could drive inflation back up. And the thing is, and this is a definite theme of the show, oil companies have been putting in less than half of what they used to put in since 2015. That means every year, by an estimated 40%, they're underinvesting in terms of future exploration, future projects. At some point, that could catch up big time because demand doesn't seem to be going down at all. If anything, it's been going up. So there could be real energy shortages in the future. The government's squelched it in a lot of ways around the world because of the environment. And I understand they're thinking to a point, but energy could be a real black swan that nobody recognizes, and it could reignite inflation. On the other side, aging populations are, by their definition, deflationary. As people are younger and saving for retirement, they save. They put money in the stock market. They buy other investments. They're increasing their wealth. As people get older, they tend to spend down their wealth to live in retirement. So that's a deflationary factor. The government keeps putting money into the economy in huge amounts. That would initially, at least you think, be inflationary. For sure. I mean, and the unfunded liabilities are unbelievable. It could be easily 5 times the debt that they're saying they have when you count Medicare and Social Security. And by the way, that's a worldwide problem, unfunded liabilities. By the AI could be very deflationary in terms of 2 things. McKinsey just this week came out with a report that said, or I saw it yesterday, that said 30% of all American jobs could be automated. So we're talking about huge job losses, which will be very deflationary, plus cost savings for companies through AI will be very deflationary. They'll just save money. So the question, and our panelist Kim today, if you're an investor, should be planning for inflation, deflation, or stagflation. What do you think, Kim?
I'm afraid of the stagflation because it creates, for me, it just creates a high unemployment rate based on, some of the numbers that we see. But deflation, deflation is very scary because you start seeing more layoffs. There's a huge slump in consumer spending. So I think deflation is also very scary. So.
And what about inflation? That could be scary too. They're all scary in their own way.
They're all scary in a different way, but those 2 scare me more as an investor. Exactly. Those 2 scare me more than inflation
and stagflation. Well, in a sense, I think you're right. But first of all, it's a trick question because
it is.
The answer is, what's your time frame? So this year, I'm definitely concerned about inflation, and next year, because I don't think the Fed has got things under control. And if they don't, the market's going to tumble. The market's going to go into shock because it refuses to even face the potential reality, although many analysts say it, and many people say we're not finished with inflation, but the market as a whole seems to be thinking everything's perfect, everything's great. Inflation's going to be gone because certain numbers which were effect and not cause have gone down. But I'm very concerned about inflation for a year or 2. But in the long run, I definitely think stagflation is the problem. And I think this is where we're going. Well, number 1, demographics is destiny. We're aging populations. It's just around the world. That's very deflationary. AI is going to be hugely deflationary. People losing their jobs, unfortunately, new jobs will be created. But if McKinsey said 30% are going to be of jobs are going to be automated, or work is going to be automated just by 2030. What about 2035 and 2040? And 30%, I don't think the economy is going to grow 30% of jobs to replace it that quickly. Not to mention AI is going to keep advancing and advancing. So this is a big threat to the workforce. And again, a huge cost saving, because all these companies can start laying off employees and saving money, which will increase their profits, and which means they can say, we don't need to raise prices because we're making more and more, and we can lower prices a little and still make more. So these are deflationary factors. And then the government printing money. Now, this is where it gets tricky. Everybody would think they're going to print so much money around the world, all the governments. I've looked at Asia, I've looked at the European countries, South American. They all have big deficits on their retirement plans and gigantic deficits for medical care, free medical care in many countries for aging populations that they haven't funded. So they're going to be printing money because they can't tax that much money because there isn't that much money. It's more money than they could possibly tax. They'd have to take everything from everybody and it wouldn't pay. So they're going to print money. What are they going to do, though? They're going to use yield curve control because they can't afford to pay the interest rate. There's no way they can pay 2, 4, 8% on this massive amount of money printing. They can't do it. They're going to have to drive rates down. And that's one of my 2 arguments why we're going towards a near zero rate of environment in the next 5 years or so, 7 years, 4 years. And what they'll do is yield curve control. It's been done several times. The United States in World War II used yield curve control. You can look it up. Basically, the government says any yields over a certain amount on our bonds, we're just going to buy them back. So they're basically buying back their own bonds. Sounds like a little bit of a Ponzi scheme. But also, Japan's been doing this since 2016 and successfully kept their rates very low. It slows their economy, but it also kept rates low because the market realizes, well, if it's over this amount, we can't even get it. So we'll just buy it at this amount. This is the most we can get. So they're basically printing their own money and buying it from themselves. So the government's going to, unless they lose control, in which case it's going to go totally kazooie. But I don't think so. I think they'll get away with this yield curve control, especially in a deflationary environment from the other factors. So at that point, the bottom line is, what do you do about this? Because that's all bad news if it's stagflation, especially because that's what the government needs. They need inflation to be higher than interest rates so that inflation eats away at some of the money they're printing. So they want it, and the governments usually get what they want. The higher the inflation rate, the more the money they're printing won't affect the economy as much because everything will be adjusting, except for it'll affect people. So the bottom line on the positive note is, so this is why you should prepare. Oh, one last footnote. Look at a 30-year Treasury yields. And since the last 40 years, it's been going down until COVID in a straight line, almost perfect straight line, heading towards zero in about maybe 5 years. So that trend will continue again after we get through this inflation fight. And in the end, it's probably heading to zero or close. So even last year, it was very low. So what do? Well, the bottom line, the positive side is prepare when you can. Buy dividend stocks, buy income, long-term income. I'm buying 30-year treasuries in my IRAs. I don't care. If I get 4%, you know what? Last year I couldn't get a 2. You get like 2% in a muni and maybe 2 point something in a treasury. It could easily return there for the rest of our lives. So this is a good time to lock in income. And then if you're wrong and the rates go high, at least you have the income to reinvest at higher rates. But I wouldn't count on that because I think there's a lot of forces pointing towards lower. So we're starting to run out of time. We have one more show, as I said, for this summer next week. And then we're going to take a brief break if you're watching it because we're going to rerun the shows during the hiatus of two or three weeks. So as Kim always says, get healthy and get wealthy, one of my favorite expressions. And we'll see you next week and have a good week. Bye-bye.